Hello and welcome to the MoneyMagpie webinar, all about how DIY investors like us can pick stocks and shares like the pros. Now, remember, as usual, nothing that's said today should be taken as financial advice. This is not financial advice, it's just information, and that you do with it what you want. If you would like financial advice, there are lots of financial advisors around, and we have articles about it on moneymagpie.com. This is an open Q&A, so feel free, as I said before, to either put your hand up to ask a question or click one of the reactions things, or just put it in the chat box at the side. Nothing in today's session should be taken as financial advice, but we are open to all kinds of questions. Nothing is too dumb. No questions are too silly, because frankly, if you're wondering it, it's probably likely that half of the other people there are wondering. So don't feel that anything is too much of a silly question. There aren't any silly questions here. But boy, have we got some information for you. And I'm thrilled to have some really good experts on our panel. Firstly, we have A.L. Perry from Aurora DIY Investing, our lovely sponsors for this webinar. A.L., give us a wave. So A.L. is here and he can answer questions. Hello there. And he can answer questions on investing in any sector, anywhere in the world, as well as showing us how we can use the Aurora platform to get the information about companies and funds. A.L. has over 30 years of banking and finance experience and is the founder of Aurora. And the idea is to support investors like us with professional, independent and easy to understand investment research. Frankly, we all need it. We also have my loveliest of friends, Justin Erket Stewart. Give us a wave. Yeah, thank you. Who was the co-founder of Seven Investment Management in 2001, building it up to £15 billion fund under the management before his retirement in 2019. He's now the chairman and co-founder of Regionally, which is innovating new investment services to the regions. Previously, he founded Broker Services, which became Barclays Stockbrokers, and that actually is where I first met him, not in my capacity as a financial advisor, but in my capacity as an after-dinner comedian, frankly. So,
and it was very funny.
Thank you. Justin and I go back a few years. And Bill Kay, give us a wave, Bill. Bill is former business editor of the Sunday Times. Hello. And currently an investing columnist on the Times Tempest column, which analyzes companies that you might like to invest in. So this is all about how to choose individual companies and funds to invest in. And I'm going to start the ball rolling, but give us your questions as soon as you like. I'm going to start with Justin. Justin, you have, as I've said, you've run investment funds, Barclays, Stockbrokers, Seven Investment, etc. So you've had access to really good information about shares, funds. But what about individual investors? What are your biggest pieces of advice to individual investors, particularly those who maybe are starting out?
Well, the answer is, as we started off by telling you about questions and things, always ask questions. You said there's no such thing as stupid question, many stupid answers. One of the greatest things we can all do as investors, I think we've all done it one way or another, is actually trying to educate ourselves. Now, it's very old-fashioned now, but we went through a period, and Bill will remember these, and Jasmine, you will too, where there was a spate of investment clubs setting up. Not so much people make themselves a fortune out of it, but actually probably meant once a month they got completely blotto, but that's not the point. What it meant was they started to learn about what shares are like, how they trade, can you trade, what the costs are, how the market works, who the participants are, and frankly, where the holes are and the dangerous areas, which still exist today, but people only tell you about them afterwards quite often. So really actually have, it's a process of education, which can be rather dull. Turn it into an investment club with some friends, well, they start off as friends anyway, and you can actually have some fun doing it. And then putting a little bit of money aside every month, and we talk about 50, 60 quid or something like that. But as a group of you, 10 or 15 of you together, if it goes horribly wrong, well, you can love 50, 60 quid. As opposed to actually saying, listing some silly git in red braces, saying, here's a good stock to buy, and you send several £1,000s, and the money just disappears down the Swanee. So education, but also galvanizing the interest to heaven forfend, even make it vaguely entertaining.
Oh, crazy. That sounds like a lovely idea. It's a good point. I hadn't thought about investing clubs because they were popular back in the day. And why not have them again? Now,
well, I've still got one. I mean, I bet it's ridiculous. It is because it's a group of chums.
Yeah.
And none of them are investment management at all, or financial services. But they've been able to now learn things they would never have found out before until it was too late, like pensions and returns and all those sort of issues. Yeah. Sorry, I should shut up.
No, that sounds fun. I want to join. Thank you. Eyal, you've set up Aurora to help individual investors access good investing information. So I'm guessing you feel that ordinary citizens like us can manage their own investments. So do you think more people could and should do it for themselves rather than rely on a financial advisor or broker?
Yes, first of all, I hope there are not too many advisors with us this afternoon. So, but I believe that everyone can choose to manage investment either by himself or relying on advisor based on his knowledge, time, and confidence. I believe that people in any case should take control of their financial future. Now, the involvement of the digital investment tools, the financial data research, and social media enable them to invest by themselves or to control and challenge their advisors. In either case, the technology is out there, not only to manage the portfolio, but to get the kind of data and analysis that was previously only available to institutions because it was so expensive. At Aurora, what we have taken on that challenge by making the high-level analysis and data accessible to DIY investors.
Okay, so you're saying that there are there's help out there that there wasn't before. There's lots of
yes. We see what happens during the Corona crisis. We saw what happens with platforms like Robinhood or even platforms in the UK. Millions of young investors are joining and invest. They have more time. They are sitting at home. But in any case, we see that the investment was booming. We also see a huge competition on the brokerage. There is new brokerage firms even in the UK. So there are much more available platforms for people to invest. What they needed, of course, they need financial education. They need some experience and, of course, some confidence. But it's not a rocket science. Nobody should think that those advisors have seen the moon or something else. You can start, by the way, you can do it, and this is why we choose at Aurora to be independent and to actually provide independent, unbiased research, which is not related to any bank or broker or advisor, because we want to be unbiased and independent. So I think there is a lot of room for new or young investors to start and try it and to learn. And they don't have to start investing immediately money. They can do it with demos or with virtual investing. So, but I think in any case, they should take control of their life and their financial goals.
Yeah, so as you say, it's not rocket science. And Bill, what do you think? Bill, what do you think is the most important thing to look for in a company that you think you'd like to invest in? Given the fact, as Eyal said, it's not rocket science. So, you know, what are the simple things you can look at?
Well, it depends what sort of company you're looking at, and that in turn depends on what you as an investor are after. I mean, without being too profound, you've really got to know yourself. We come on to the whole subject. I know we're going to talk about a risk. And the level of risk you're comfortable with will determine the sort of companies you will look for. And then once you've decided what you're looking for, then you've got to decide what particular elements in those companies are going to bring you the best sort of reward. Sorry, so it's a bit philosophical, but really, yeah, people do force themselves into doing things they think they ought to do, or they've been told to do, or read about. But the first thing is you've got to be comfortable with what you're doing, whether you're going to company investment at all. But once you do, what sort of companies? Whether you go investing in bookmakers or mining companies or tobacco companies or whatever. It's all a matter of your personality.
I've got a question here from Buran, and Eyal, I'm going to ask you this one. Do you have any suggestions or advice on investing in Sharia compliant stocks and shares, please? That's an interesting question.
Actually, I'm not that familiar with Sharia investment, so I don't have any advice at this moment.
Okay.
But I can check. I know the region, I know what it means, but I have no experience with Sharia investment. So sorry.
How about Justin? Do you have any ideas about Sharia compliant stocks and shares? What's your thoughts?
Yeah, I mean, if you go to the Middle East, obviously you'll find its whole structure there is dominated by this. But the Sharia rules will vary according to interpretation. So it depends on how strict the interpretation is from your mullah on the investment board happens to be. There's one firm I came across in Kuwait where the investment manager had 16 items to invest in. So 16 companies or bonds in the entire world.
Wow.
That was a somewhat extreme version of interpretation of mullah. You can get obviously much lighter versions known as mullah light. Not known as that at all. But the point is, you can research that into to put that in as a filter, and you'll find different interpretations. To me, it's a bit like with the interpretation, when these days we're all having to talk about ESG and environmental, sustainable, and governance. It depends on your interpretation. That old line that I think nicking Bill's line, actually, ethics was probably more likely to be a county in East Anglia rather than anything else. Everybody's interpretation is very different. You've got to find the one that suits you, that actually think this is the right way to behave. What's interesting over the past 2 or 3 years, how it's radically changed. We set up a sustainable fund back in, about 17, 18 years ago, and it was perfectly good, but no one was really interested in it. They used to have can I have a little bit sustainable, please, as opposed to salve their conscience. In the past 2 or 3 years, that's really rather changed. Many more people say, I want to have a responsible investment, which is actually environmentally sustainable in terms of its operation, and good governance, i.e. people not lying.
Well, that is nice, and actually that's a really good point about ESG, because AL, we said that we were going to look at what you can get, what information you can get on your platform, on Aurora. Yeah. So I wonder, I mean, let's say ESG. Okay, so say somebody is thinking, I want to invest in an ESG fund, and I want it to be have positive impact on the world, on the environment. So not just sort of negatively, it's not going to do too much harm, but I'd like a fund that's actively trying to positively help the environment. How would I find that on your platform? Can you share?
So I think one of the key elements is really to find funds by their investors. We are covering ESG. We even have some track for ESG that mentioned that this is an ESG fund, and so it's either you can identify them by the area or the region they invest, for example, energy, green energy, or either directly by the track that say this is an ESG fund. Honestly, from my experience, I think from what I've seen, ESG is very relevant for institutions. It's more of the times it's less relevant for individual, but again, we see a very good returns from the alternative energy in the last couple of years. We know that the Americans are going to invest billions in the global warming, in new energy. So I don't want to recommend but it's a very interesting area, and we actually help to identify those funds. We are covering 15,000 funds. Some of them are ESG, but again, it's good to combine a good purpose, but it has to be combined with good returns and the quality of the fund. So, and I think what is also important is to compare. There are many ESG funds, and it's quite easy to compare between the promoters, between the performances, and of course the management fees. So even if you want to invest in ESG, there is a lot of room to compare the funds and see what are the quality of the managers, what they did in the past, and how much they cost. There is also a big difference in the prices, in the cost, the management fees that they charge.
Right.
Which is not all the time correlated to the performance, by the way.
Right. No, I can imagine. Bill, I know that you invest for dividends particularly. Can you explain what that is? Because I'm thinking, I mean, I'm still thinking ESG here, because I remember you saying that some of the ones that pay the best dividends are not exactly ESG.
No, well, it comes back to what I was saying earlier. If you want to add that layer on, a non-financial layer, if you like, whether it's ESG or some sort of political background or whatever, then you've got to build that in first before you start selecting funds, because clearly you're going to want to select funds that fit in with whatever your sort of overriding principle is. And so in doing that, you may give up certain amounts of financial return, whether it's dividends or growth or whatever, for the sake of your principles. I can't afford principles myself, but for those who can, that's what you've got to do. And if you're going for dividends, well, you've got to look at, first of all, the dividend record. Secondly, whether a company is making enough profit to pay out a regular dividend or increase the dividend. So you've got to do a bit of homework on that. And in many cases in ESG, they've got a lot to do without paying out dividends yet, or without generating enough cash. So that's just one of the sacrifices you have to make for the sake of ESG, for example.
Let's just explain again what a dividend is, because dividends, I think, are something that, particularly if you're looking for an income from your investments, they're very useful to know about.
Well, I mean, a company hopefully makes profits, and those profits start off at a trading or a gross level, if you like, and then they're whittled down by tax mainly, but also by depreciation and other factors. So you come down to a net profit, and it's from that a company can pay a dividend. I mean, some companies do temporarily pay out more dividend than they've got profits. That's rather risky. A conservatively run company may pay out half of their profits as dividend, and it's really a distribution of profit to the shareholders. And in a way, that's what investing is about. I mean, you're investing in a company that will generate enough profit to give you a return, and the main return really is dividend. When you also get the growth in the share price, but the dividend is the big return.
So dividends, as you explained, are it's a share out of the profits. And yes, you would think, in a way, that all companies would go, oh, we've got shareholders, we should give them a bit of profit, because that's what you're supposed to have when you're shareholders. But that's not the case, is it? There are lots of companies that make a nice fat profit and then keep it to themselves.
Yes, particularly in boom times. I mean, I remember during the dot-com boom, talking to a lot of companies and saying, when are you going to start paying dividends? They said, dividends? No. The money is far better left with us, because we can deploy it far more effectively than just giving it to silly old shareholders. Well, I don't, as you can gather, don't buy that. Yeah. I think any company should have in their business plan a date when they want to start paying dividends. I mean, when you're starting out, you have got, it's all hands to the pump, and all the money has to get ploughed back in. But there has to come in my book, a certain stage when you say, right, we've got to start distributing money to the shareholders.
Justin.
Just building on what Bill's saying there, this issue of dividends or coupons, which will be the same thing except dealing with a company bond or government gilt or something, are probably the most important part of your investment. Here you have to differentiate between a proper investment as opposed to having a punt. There's nothing wrong with having a punt. That's why we have racecourses. But actually, if you're investing money on a portfolio over a longer period of time, your primary driver for success is going to be compounding those dividends every single year. And that's how you see your money grow. There's bore you with the old rule of 72, which is one of those silly things, which is you divide into 72, the approximate sort of return you think you're going to get. So for ease of my stupid brain, let's say 7%. So 70 to 72, roughly 7, your money is going to double every 7 years. Now, it may not sound wildly exciting, but the point is you start getting a measure then as to what your return you want to have to try and get, as opposed to what you are actually getting. But in the longer term, actually, you'll find that it's coming down to a successful investment. It's time and it's compounding. It's all too easy to spend your time fretting over individual small stocks, buying and selling. And I always tend to actually separate my life into two sort of separate worlds, such as my sad mental capacity. One, which is having a fun bit of the portfolio to buy and sell shares. Then there's the other bit, which is much, much more important and much larger, which is my long-term money. So when I get round to properly retiring or find I'm no longer employable, actually it's happened some time ago, and that actually I can open the box and the money's there, as opposed to going along to quite a few investment funds and investment managers or pension fund managers, and you get to the age of retirement, open the box, and oh,
yes,
not
exactly
what you expected.
It's those charges, isn't it? And actually, speaking of charges, we've got a question from Jason here. He says, do you have any suggestions on in trading platforms other than Aurora? Actually, Aurora is not a trading platform, it's just research. Which one should you use? It's a very good question, and we always get this question. I mean, Jason suggests eToro, for example. What should people look for in a platform? 0% commission, a variety of options, etc. There appear to be so many to choose from. Yes, there are a few to choose from. Justin, do you have a view on that at all?
Yeah, the trouble is we have more platforms in this country than Network Rail. It is quite astonishing. Oh,
sorry. I think I've just, I've just muted you by mistake. Sorry about that.
All right, I'm back there, is that all right?
Yes, thank you.
So we're looking at a platform, a whole series of things you have to look at, and you have to be very careful here because some leading investment management houses, I won't mention their names now, will, I'm afraid, mislead you in terms of the charges you're actually paying. It can be death by 1,000 cuts. One particular stockbroker, who should be nameless, Bruin Dolphin, actually produced a booklet on charges because there were so many of them. I remember having a big argument with Barclays over it, because it's not just your ISA charges, your pension charges. Barclays actually once introduced an inactivity fee. Brilliant. If you get charged for doing sod all. But then you've got actually commissions, whether you buy and sell commissions or not. If it's funds, what those charges are. And they're not always the obvious charges. They're costs sometimes taken out of the funds or out of your account. And so you've always got to put together all these elements to actually say, actually, what is this costing me? And so in many ways, the industry has been very clever to itself by making it to give so many alternatives that it's very difficult to get the biggest picture, the whole picture of it. All I would suggest is you go around people who are already using different platforms because they're constantly changing, and find from a user perspective which one's best for you in terms of understanding the language, because some of them, frankly, are utterly appalling, understanding the sort of services you're going to get from them, and of course, at what cost. The key issue also for me is also, by the way, and where are my stocks? Because they often be in a nominee account or something like that. And has that suddenly disappeared? Who actually controls all of that? So I'm afraid there are legions of questions to ask, but I'm afraid this is your homework before you get investing.
Yeah, it's true. And you know, you mentioned eToro, and that is certainly one of the issues that you've said, you know, where are my stocks, etc. And I think that's a bit of an issue with eToro. I like what eToro, I've got some, you know, I like the idea of following people, and I follow somebody who's a really good investor on eToro, but particularly when it comes to crypto, you don't actually own the crypto that you've bought there. So that's potentially a bit of an issue. But we do actually on MoneyMagpie, we have an article about some of the main platforms like Interactive Investor, AJ Bell, Hargreaves Lansdown, Charles Stanley, you know, and they are kind of much of a muchness, as Justin says. You know, in my experience, some of them will be better if you don't trade very often. Others will be better if you trade a lot. You know, all of that. Bill, what do you think about these trading platforms? Any that you like, or what would you look for?
I avoid them like the plague. I'm very old-fashioned. I just go. My main concern is to keep the investment, the dealing charges down as low as possible. So again, it comes back to what services you want. I'm happy using what's called an execution-only broker. The minimum charge, it's the one I use is XO Co UK, which does all I want, which is not very much. It just records the prices, it keeps my portfolio up to date, and it receives my dividends, whoopee. But that's all I really need, and I accept I probably know more than most investors. A lot of the platforms will give you a lot more help, but you will pay for it. You pay for what you get.
Great. Now I've got, Izzy, thanks for your question. Izzy asks, how do I go about ensuring my investment portfolio is diverse? is there a mixture of sectors I should go for to ensure that? Now, this is a good question, because we're always being told you've got to diversify your portfolio. In other words, spread your bets. Don't put all your eggs in one basket. Justin, what do you think?
Well, I think one of the basic elements of this are different asset classes. Now, what's an asset class? The answer is it's groups of things you can invest in. So you could say that shares, equities are an asset class, bonds are an asset class, property, commodities, cash even, and some are even stretching as far as cryptocurrencies as well. So they're also, the idea being that these different asset classes have different modes of behavior. So therefore you probably want to have a spread of all of these, and it's a matter therefore of then seeing how risky you want to be. So traditionally people would, for higher risk, would have more in equities, say, than bonds, but then you'd have something which is more balanced, bring in other asset classes as well. There is a very good, I don't know if they still produce it, but Fidelity have, and I know certainly Investment Manager used to produce it, which is a year-by-year little color chart of how asset classes have performed. And so very simply dividing up into, say, US equities, European equities, and then bonds and property and X, Y, and Z. And it just shows you actually how variable and volatile these can be. That old line of this year's fashion is next year's tank top. And often you'll find those ones with asset classes have done really well for several years, to the extent that people then pile into it and it then probably turns into a dog. So the whole idea, as you say, eggs in one basket, nobody knows the future. But what you can do is diversify some of that risk on the assumption that not everything is going to go down at the same time. Sometimes there are nasty shocks when, almost they do. But even if you've got cash, well, you can still lose money on cash, as you're seeing at the moment. Your interest rates are lower than inflation.
Yeah. Eyal, there's also now the possibility to diversify globally. I mean, you don't just have to put everything in British stuff. You can literally invest anywhere in the world, can't you?
Yes, I think that part of diversification, and we see now what happens with the different currencies. There is a big fluctuation in the market. So I think now there is opportunity to invest all over the world. And I don't see any reason why a British investor will not invest in EU or in the US, because we all know that when your exposure, even if it's your economy, it's still exposures. And there are the Brexit and some other effects, or even the COVID. And I think it's a quite a good idea for investors to look also on other markets, not just the UK, for example, US, Canada, EU, and especially with funds. I think that if we would like to go as far as we would like to go with funds, even for emerging markets, the best tool to use is funds. And not because usually we will not buy directly stocks in those markets, but still we see some emerging markets, some growing markets that give us nice returns, and also diversify our portfolio. So, for example, if we are looking for the best real estate funds or the best real estate markets, we see markets even like Switzerland, which they are quite stable. It's a AAA country. The returns over the years are quite good. So there is no reason why not to look on other markets, not just your own, and it's part of diversification. It's certainly thing to think about.
Yeah, that's interesting. So you using your platform, we can have a look and see, as you say, which funds, and you're saying funds really are the best way to diversify globally.
I think, of course, everybody, if we go to the big stocks like Apple, Tesla, and all these, we don't need funds. But of course, as far as we go, it's better to use funds. Let's say if you go to Asia and to go to other regions, I would use funds, not directly buy stocks, but at least a small portion of my portfolio. I don't see any reason why not to diversify. As I say, for example, real estate funds can be a good example. Most of us would like to, or many of us would like to invest in real estate, but we don't have the funds to buy or a mortgage to buy a house or to buy an apartment for investment. So there are many interesting things, or let's say energy funds. So I think there are many interesting investment outside the UK, either in EU, America, or even Asia.
Interesting. Got a question from Kerry here. She says, so it's an eToro question. I'm currently investing in crypto on eToro and investing for long-term returns. Good. As you mentioned, do not actually owning them make a difference. You see, I've actually got some crypto on eToro as well, and it seems perfectly fine. And I think it is perfectly fine, just so long as it all keeps going. And of course, eToro is a big company. It's going great guns, really great guns at the moment, and it is global. So I think, you know, it's fine. But I think if you want to be really a bit more solid, then you're probably better off using a platform like Coinbase, which has been around for, you know, longest really, and is the biggest, and you do actually own it if you're there. Binance is another one, although the FCA in this country doesn't like Binance, so it's probably not a good idea. Kraken could be a good one to try, but probably Coinbase, although it's more expensive, frankly. Then it's not so good. Oh, you started using Finico. Oh, I don't know Finico. That's interesting, Kerry. We must find out. Let me know what it's like, because that's not one I've looked into. So Finico is, I'm guessing, an actual platform. I better look that up and find out what it's like. Good question, Kerry. Nice. You always come up with good questions, Kerry. Now, Shabu, so Binance is from South Africa. Is it from South Africa? Now, one of the problems with Binance, I think, is that it keeps changing where it's located. And I think, as far as I can tell, for tax purposes. So yeah, maybe it is because it's from South Africa, but from what I've heard, it just keeps saying that, you know, it's in Thailand, and oh no, it's in the Ukraine, and oh no, it's, you know, that's that's what I've heard. And their currency varies. Yes, absolutely. People say, now this is a question for me. People say, Bill, invest what you know, invest in what you know. But and I've seen this in adverts, you know, for investing apps. It goes, you know, invest in the companies you love. But I do think, well, is that really the best advice? Because, you know, you might work in retail and you know about retail operations, but on the whole, retail isn't a great sector to invest in. You know, same with banking, really, at the moment, not necessarily. So, is that a good thing to do, Bill?
Well, all sectors have their day. I mean, if assuming you're going to invest in a sector that you work in and what you know. Let's assume for simplicity you work in the same sector all your life, say retail, then you will know an awful lot about that sector. Now, if you invest purely in retail, then the first thing you're giving up, referring to the earlier question, is diversification. By definition, you're not really investing in any other sectors. Mm-hmm. However, you can be expected to know a heck of a lot about retail. It comes back to the famous now late lamented investor Jim Slater, who wrote a book called The Zulu Principle. And that was based on the idea that if you go and find out all you can about Zulus, you will become the world expert very soon because no one else knows about them. And you can therefore see a lot of investment opportunities in whatever the Zulus are up to. Now, in retail, it comes to the same thing. You'll know the sector, the good companies, the bad companies. You'll also know, you'll have an early idea on whether the sector is going to go through a bad period, in which case you can get out and get in early when it recovers. So I think there's a lot to be said for investing in what you know, subject to the fact you do lose the whole benefits of diversification.
Right, so it's maybe a good idea to stick with what you know, but then have a little look at, maybe you'll get interested in oil and gas, or you'll get interested in entertainment or something like that.
Well, if you're in retail, the thing is that retailers have their suppliers. And if you're in retail, you know who the good suppliers are. And all of a sudden, you're not just in retailing, you're in manufacturing and you're in distribution, because that's all part of the retail network. So one thing leads on to another, but at least you started from a position of knowledge and confidence.
Justin.
I just picking up on what Bill was saying. There's a lovely thing actually from Jim Slater, I remember, when he was going about a Zulu Principle, which is a very good book, by the way. It's very sound principles. But I said, so as a result of this, you lose your money. He did not think that was very funny. He did not well known for having a sense of humor. But a couple of things here was interesting. Just, I'm all in favor of global investing, part diversification. The good news for actually British investors The FTSE 100 is not a UK index, it's an international index. Probably 60 to 70% of the turnover is actually effectively from overseas. And I don't mean into the shares, the companies themselves I'm talking about. So you can be international domestically, perverse as it seems. Also be wary that actually those markets you've got, we tend to apply, oh, it's stock market, runs like us. No, it doesn't. And so the different levels of regulation, control, protection, and trading, you do need a lot of work to do it. So therefore, as I said, so going by funds there, it's a very good way of going through it. The issue with funds, then you have to decide, am I going to have an active manager who's actually buying and selling, or he or she's buying and selling based on their knowledge, or do I have a passive one, which is merely just tracking an index? It may sound it's rather dull, but for the past few years, if you had invested in the US and the NASDAQ, and some of the passive funds there are really very, very cheap indeed. One of them, actually, it was quite astonishing, about 4 years ago now, had no fees at all for the first 2 years, just to try and get people interested in it, which of course they were. But all you're doing is tracking an index. You can get dividends off that as well, depending on different types you have. But it means you've got a choice there to be able to go through. So you can still get overseas exposure, but you don't necessarily have to start picking individual stocks, which leads me on to one other thing, if I may. I was on the tube yesterday, but such is my sad life, I spend my Sundays on the tube. It's an exciting world. And I came across an advert, had to take a picture of it in the end, of algorithms for cryptos. We'll give you 50 euros to come and open an account with us. And all you have to do is our algorithm will then make money for you with very, very small writing at the bottom saying, this is not regulated in the UK. But there we are. On the district line, it will no doubt attract an awful lot of people into something where they haven't got a sodding clue. And that worries me.
The average IQ of district line travellers is about 50.
Well, I can tell you with MoneyMagpie, every other day we get crypto companies and Forex companies wanting to advertise. And pretty much every single one we get, no. Much of the time, I mean, I like crypto, I invest in it, but, I look at this and I have no idea. And so if I have no idea, I haven't heard of it, I think, oh, no, because so much of it is totally dodgy. I agree, absolutely horrendous. Now we have more questions here. One of them, oh yes, Vic, anyway, I'm trying to set up a junior stocks and shares ISA account for my children lately, and most of the investment platforms have various commissions, I think you mean, annual charges, etc., that might not make the children's account viable after a few years. Do you have any suggestions for children's investment accounts, please? What do you think? Justin, I'll go back to you. What do you think?
I have to say, I'm not very knowledgeable of the different types of accounts with them. They're junior ISAs. I always find what we should be doing is actually having full your whole life investment, not actually getting an ISA starting it when you're naught and then giving it to the dear little brat when they're 17 or 18. Well, you know full well actually what's going to happen. Then I might as well go and put the money in the student bar myself and just do without the costs. What we need to do is encourage people to have a lifetime investing starting from naught. And I would actually almost make it compulsory, so that by the time you do get up to sort of 50, 60, 70, 80, your money's built up over time. The same principles should apply to a junior ISA as any other ISA, because at that stage, what you're trying to do is build long-term value, lower cost, with a clear view as to what they're investing in terms of risk profile that you actually understand, and then let it cook for the long term. But be wary. A lot of these people will have individual charges. Often they'll say, oh, the ISA wrapper's free. That's because they charge you a nominee fee or something else. So nothing's ever properly free.
No, so what you're really talking about is setting up a pension for your children. Yeah, because that is a great one, because you can put up to £2,880 per year, and the government adds in some lovely tax, making it £3,600 every year into a pension. So you can set up a SIP for your child, which is, well, there are still charges there, aren't there, Justin?
Yeah, but they can keep those really pretty small. I did that for my nephews and nieces. There was not a huge amount, actually pretty tiny amounts in there, but just basically as soon as possible, they learn to know what a SIP or a pension is. They can see how it's growing, what it's doing. And so it's something which isn't, something, oh, I don't want to know about pensions. I'll find out about that later when I'm middle-aged and old fart. But actually getting that knowledge as early as possible. I know we discussed this before, Jasmine, but we must get, and I know they're trying to do it rather half-heartedly, that finance and investment should be in the education curriculum for people. Then you make it part of the maths curriculum so you can actually understand what's going on. At the moment, we have people leave universities with 30 to 50,000 pounds worth of debt, with really not cheap in loans either, without a diddly squat of an idea of how they're going to pay it back or how much they're going to need by the end of their life.
Yeah.
We've designed, well, we haven't designed it. It's a bugger's muddle and needs a huge amount of reform. Go on, that's what MoneyMagpie should do.
Well, I agree. No, you're absolutely right there. Absolutely right. Bill, do you have any ideas about platforms that would be good for a junior ISA?
No, not offhand. I mean, I think the best advice is to Google junior ISA and look for the lowest charges, subject to the fact that whether you've heard of the companies providing them at all. I mean, don't go completely blind. But the thing is to keep the cost down. Of course, the attraction of ISAs is that you're going to save tax, or there's going to be tax relief. But as Justin says, the biggest virtue of all is actually getting your children or your nephews investing and getting some sense of the stock market and some sense of finance. But I haven't got any ideas on individual platforms.
Well, we have another question, which now it's Buran has said, now this is a bit unrelated to stocks and shares. Yes, it is. What about investing in buy-to-let? Who has a view on that? Justin, do you have a view? Oh, sorry, Bill. Yeah, Justin, right.
No, sorry, Bill, carry on.
I was only going to say, one of my guiding principles is not to invest in physical assets, because physical assets can deteriorate, they need maintenance. In the case of buy-to-let, people live in them, people don't live in them. I much prefer to buy pieces of paper, thank you very much, but maybe that's just me. I'm sure Justin's got much more interesting views on buy-to-let.
Justin,
I think you're right, Bill. The key issue that was good for buy-to-let was you had some really good tax breaks. So you could actually borrow money, and then any of the rent you got, you get your offset against your cost of borrowing. So effectively, you're borrowing for free. So you can build up a wonderful portfolio in an incredibly tax-efficient way in terms of cost for doing so. And then, of course, property, as people always will tell you, property always goes up, apart from the period when it goes down. But everyone seems to forget the down bits. And so all the benefit that was there for buy-to-let has virtually disappeared. I actually found myself with 3 buy-to-let flats, which I always said I'd never have at all, but for reasons of far too much complication now. And they're just a pain in, well, where you expect the pain to be. So frankly, consider the effort you have to do to get a reasonable return on that. I don't think it's worthwhile at all at the moment. Keep your investing simple, so you don't have too many moving parts going on. The thing about buy-to-let, it's not just a matter of the investment and getting the rent and the hopefully property value going up. You've got something as tiresome as a tenant, who of course is barely house trained and has actually no interest whatsoever in necessarily keeping the place into the standard you hoped it would be. But still, that's enough of my family.
Well, I'm of the same opinion. I mean, I do hear that, as inflation goes up, and we're expecting even higher inflation next year, commodities and physical assets tend to go up. So I think it is possible that house prices will go up, rents may go up as well. But yeah, for me personally, I do find it too much of an effort, frankly, to keep it going. However, I have done a podcast with Jill Fielding, who runs Fielding Financial, and they give courses, everything from an hour to a few years, on how to invest, how to be a proper buy-to-let landlord, how to make money out of property. So do have a look on our YouTube channel or on MoneyMagpie, because that is a really good interview. Actually, she's very, very passionate. Bill,
I should say, I've been arguing against myself, that if you really want to make a hobby out of buy-to-let, or indeed a career, I mean, some people have dozens of houses, and that's what you want to go into, and you're good at DIY, and you really want to spend the time on it, then it can be very rewarding. But I think people should know what they're getting into. It's not an easy investment unless you really put the time and effort in.
Absolutely. Now we've got a few more questions, but Eyal, I'm just going to go back to you, because you are our lovely sponsor, and I'd like to explain to people a bit more about what Aurora does and how cheap it is, because what do you charge per month for this research? And because you're not pushing anything, you're just pushing it's just research that we're paying for.
Yes, as I say, we decided to go only for the research, and we are providing unbiased, independent research. And what we do, actually, our data and research is used by more than 200 global institutions around the world. And our mission was really to take this data and research that was for professional and big institutions and to bring it to DIY investors in a very affordable price, and we are currently charged about £12 a month. Just to give you an idea, the B2B or the professional platform, which is a Swiss one, costs a few dozens a year. So what we really try and we really believe is to bring professional data to DIYs, and this is why we make it so affordable.
Yeah, absolutely. And we're doing a special deal, aren't we? Something I think you'll have to remind me. I think we're offering a free month, and then it's 20% off after that. 20%, not bad.
Yes, but I think that the most important for DIY is really to have a process, an investment process, and to use as much as they can research, data and research before they invest. And again, it's as I say, when brokerage become a commodity and the prices are going down, the real important thing is your investment process and how do you do it.
What does that mean by an investment process?
I think that what we have learned, that being systematic and consistent is the most important thing for any investor, certainly for DIY. I think that before you start and during your investment process, you should set your goals and risk appetite. As I say, use some information, different information system and platform before you invest and after you invest. And I think the most important thing is you cannot invest and forget. Either you do it by yourself, either you do it via a broker. You should control your investment. You should challenge yourself and your advisor. So it's not something that you do and then you come back after 6 months or 12 months and say, okay, what they did. It's a process, it's a continuous process. And the market are changing almost every day, sometimes even during day. So I don't think the DIYs should do trading or change their portfolio every day, but they should monitor their portfolio and their investment and diagnose it and see the quality of the risk. And we spoke a lot about brokers and platform, but it's very difficult to find good platforms that really give you a good diagnostic reports about your portfolio in terms of risk return. This is the most important thing. So even we see analysts that tell you buy, sell, hold. What is really behind it? What are the risks? Why to buy? Is it growth? Is it dividend? What is behind? So usually, if we are professional, we read the reports and we understand what is behind. But as a DIY, usually we don't have time to write the full analyst report, and we have to be very careful and be aware of going after trends and emotions like most of us are doing. So I really think it's a process that you should adopt, and as I say, being consistent and systematic for me, I think is the most important lesson for my history on my background.
Yes, I've just noticed that Izzy has put a link in the chat. She says you can read our DIY investing tips with Aurora here. She's got a link there. I will try and send that to everybody afterwards as well, with a couple of other links for you in an email. Sorry, Justin. Oh, sorry.
Hi.
Justin, hello.
Hello. So it's just merely to say something else that's coming up, and I was moving towards it. Is you're seeing more mention these days of algorithm methods of doing this. Well, the rhythm method was always unreliable in your private life. An algorithm, when it comes to finance, is exactly the same. Basically, what they're saying is there's an algorithm written which will automatically invest and change according to market situations, and it'll be run by a system. The trouble is, if it carries on operating, the market may change, the system doesn't necessarily change. So but it sounds nice and easy. I've got an algorithm running this thing for me, and you don't know actually what it's doing. So please be very careful. The other issue is the liquidity in a lot of our markets is sometimes very thin. Go outside the FTSE 250 and you think, oh, I can buy and sell these shares easily. Well, you want to buy them, well, you buy them, then you can't sell them because it's very illiquid, and then find yourself stuck. And a classic example we saw of that most recently was Woodford and his funds. And I remember you used to get terrible trouble if you ever actually sort of criticized the saintly Woodford. But I'm afraid you could see what he and some other people were doing. In fact, in mid-sized companies, they were the market. So if they bought the stock, it went up because they were the market. It also meant they couldn't sell it ever, because if they did, it fell hugely. So what it means to the innocent investor, you're following something like this that sounds all very good and logical, but unless you understand what's going on underneath it and how the market is actually being divided up, in this case, it was different fund managers working together, that can be very painful.
Yes, I agree. And now I've got a question here from Hilary Lawrence, who says, is this something for the absolute beginner? Now, I'm assuming you're meaning the article, Hilary. It is pretty much for the beginner, but it's a very good point, Hilary, that, you know, we're talking on different levels at the moment. So for the absolute beginner who is beginning to invest, Bill, would you say it's basically index tracking funds? Do you think that's the best thing for somebody to start with?
The thing with index tracking funds is it begs the question of which index to follow.
Yeah.
As Justin was saying, you've got indexes for every market. Now, should you be in America now, or should you be in London, or should you be in Tokyo? So it's not a simple decision. What I would suggest for someone just starting out is to go into a well-diversified fund or investment trust. I personally prefer investment trusts because the costs are lower, and you can get some global trusts with very good track records that are very well diversified. And I would start off with those before you start getting too specialist, and even before you go down the passive route. You need to get yourself familiar with what sort of markets you want to go into. Again, come back to the old thing of what level of risk you want to take.
Because I've often said to people, just start with a UK index tracker, you know, something that tracks the FTSE 100 or the FTSE All Share, because it's our country, and well, you would hope it's doing all right. Frankly, not sure.
As Justin was saying, you know, the FTSE 100 tracker is got an interest in around the world.
Exactly, Justin.
I just think it's interesting here. Bill's absolutely right with those funds. If you'd want to invest in individual stocks, though, how do you go about that? Well, the investment club route can be quite a good way of doing it, because people have to do a bit of research in individual companies when they bring them to the club. But I would always suggest it as an individual investor, and presume you haven't got a club because maybe you haven't got any friends, but that's just my personal life, that you pick 6 stocks and say they're going to be quite large because they're liquid, so I can easily buy and sell. There's lots of information on them. I understand their pricing. I can see the track record in terms of charts and how it's behaved. And I follow that. And exactly as Bill was saying earlier with Jim Slater's Zulu Principle, you find yourself following those 6 stocks. In 3 or 4 months' time, you'll know most, in fact, probably more than most analysts. Most analysts are fairly lazy beasts, and there aren't that many of them around anymore. But you'll find you actually know an awful lot about that company, and much more, frankly, than most of the media involved in it. So you'll then be buying into those companies from a position of knowledge. That's to say, well, actually, it's not in the usual, its price is out of whack with where it should be at the moment. Something odd's going on. A classic example was last year, a company I like following was IAG, which is British Airways, International Airlines Group. And you could see how it's being affected by the pandemic and pandemonium. But you could see how they were actually managing their way through the crisis and what they would look like at the end of it. And so you could actually, without too much risk, actually make a decision based on some pretty good information, which you could have gleaned yourself without being a financial expert. So small number, you can't cover the entire market. Don't try and do that. So if you are interested in individual companies, try and do that and just focus on a few of them. You may never invest in them because you think, actually, I don't really like it, in which case drop it. But that's where the investment club's in, because then you can actually share that risk amongst others. Everyone comes up with a view, they come up with it. All you know is the one you choose is normally the one that comes last, but don't worry, because everyone else has come up with better ideas.
Good point. Now, Lee Chen says, as a beginner, is it better to go for financial advisors first? Which is a good question. Obviously, with financial advisors, you know, a proper independent one, you should be able to get some really good advice and some sensible thoughts. It'll cost you, of course, you're talking probably at least £1,000, I would say, for a proper look at all of your accounts, you know, and sorting out some investments. It's still a good idea, though, I would say, to get some knowledge yourself, so that you know kind of the questions to ask. You're nodding there, Justin. Do you think so?
I think so, because actually a lot what you'll find is financial advisors used to have a terrible reputation because they weren't very high and provided FA. Now they can't earn commission anymore. They have to charge a fee. But the trouble is, we're not used to actually paying fees for something that was apparently free before. It wasn't free, it's just you didn't know actually where the charges were coming from. No, there's a corny old line, which is actually worth remembering, which is, if you're planning to invest, don't. Invest in planning. Get you, and this sounds really boring, but plan your finances of the family about what you're going to need in terms of assets and money to spend at a certain time across the family. You may not necessarily like your family, but you can coordinate the assets and liabilities between them. Grandma can be quite useful in her old age. That way you're then creating a financial plan, like a business plan. And therefore you'll get a better idea of what value of assets you need to have by when, what return do I need, how much risk do I have to take. And when you start doing that, you realize your returns don't have to be huge. Rule 1 of investing is don't lose the sodding stuff. Rule 2, refer to rule 1. If you can just keep on doing that. To me, financial planners are a really great help, because it acts as the bridge between accountancy, between legal aspects, your wills and things like that, the investment side, which may not be what the financial advisor does. Maybe they're coordinating it, but maybe they're using wealth managers and things below it. Coordinating all of that and then putting that across to you in a way that you understand it. And one of the great things that I saw, which was actually nothing to do with me, because I wouldn't have the imagination, but at my last business, we actually brought in people who did software games. They wrote things like Donkey Kong. The idea being that actually create something which actually behaved like I don't mean sort of, great battles of warriors and things like that, but simple, really good, easy graphics, which you could use on screen and use your fingers to find out what's going on. Now you've engaged people, and people understand. You break down the barriers. I find if financial advisors are telling you things you don't understand, that's not your problem. That's their problem. And more to the point, if you don't understand it, they can't explain it. That's a warning bell. Don't go near them.
Absolutely. Yeah, that's what I always say, ask questions and ask again. And by the third time, if you still don't understand it, it's probably that it actually doesn't work, whatever it is that they're trying to sell you. So yeah, be very careful with that. Jacob says it's interesting you say much more, you pay much more attention if you have some skin in the game. Yes, you become highly incentivized to learn fast. Yeah, that's very true. And that sort of goes back to what Justin was saying about having investment clubs. When you've got skin in the game, suddenly you actually learn a lot about what you're doing, what you're investing in. Oh, Jason, got to run. Yes, you've enjoyed it. That's really good. So now Shabu says, yeah, there's a high probability of fake news. Scary, yes, but you can't really trust some of the information on the web. No, you definitely can't. He says, your thoughts. Eyal, what are your thoughts about information on the web? Can you trust it?
I mean, you have to be very suspicious, let's say. You have to be very careful. And this is, for example, what I'm usually doing. I'm looking again for consistency and for consensus. So for every information that I see on the web, I check it from different angles or from different providers to see what they think, because we all know there is a lot of conflict of interest. There is a lot of, I don't even speak about scams in the webs, but we have to be very careful about information about in the web. And this also brings us to the previous questions about should we invest in what we know. The question is what we know. and again, we have to be very careful from trends and spoilers and all this stuff. And this is why I think that everyone should use a professional data and research tool, even more than one, and do some homework and learn the terms, and even start without really putting real money, just as a simulation. Put a watch list, follow it, see how do you get with it. Don't rush, and as I say, don't be motivated by emotions. This is one of the most important don't go after after the trend, and don't leave it too soon. So
Yes.
be very careful with all this news.
So when you say about doing a virtual one, can you do it on Aurora? And if not,
Yes,
where can
yes.
you do it?
This is why we choose to be independent, not connected, not to accounts, not to brokers, and not to bank. So you can simulate, you can diagnose a virtual, totally virtual portfolio. You can play, put in, put out, follow it, and totally independent. So you don't have to really invest. Start, and pick your 6 stocks and follow them, or funds, and see how you deal with it if you understand what's going on. This is my recommendation. Don't start immediately with the real money, or actually putting your skin into others' pockets.
Yes, yes. Just Justin.
Sorry, just a couple of things, and Ail's absolutely right on that in terms of that research and where it's coming from. It's got a bias. For example, we used to get a big fashion a few years back for individual short sellers, a chap called Evil Knievel, that wasn't his real name. And they would come on the radio and television and say, well, I short these stocks. In fact, these are the stocks I'm selling short now, which is basically, therefore, everyone is going to go out and do that. It fulfills exactly what you wanted. And all he's done is just feed the story to the market. And it's it's a real, well, it's crime. The other thing is, there was a lovely fellow, not so lovely chap, called Bernie Madoff. And he ended up being, I'm sure many will know, he ended up being head of NASDAQ, I think it was, for a while. He was so highly regarded as a great investment guru. He did his returns. And I remember my first chief investment officer at 7, she said, don't touch that with a barge pole. I said, why not? He's done very well. She said, what's he investing in? You have no idea. And in fact, it turns out it was a Ponzi scheme, and he had exactly the right name because he made off with the money.
Bill.
Well, if we're coming back to the original question, which was about fake news, if you're in the UK and you're starting out in investing, there's no better website to start off with than the LondonStockExchange.com, because everything in there is absolutely reliable. You can look up any company; it'll tell you the share price chart, what the company's worth. There's massive information, and all their own statements, their annual and half-yearly bulletins, and it is absolutely reliable information. It's a very good starting point before you start going into what sort of research you want to do.
Excellent. Well, we've come to, we're a bit after the hour. It's been a great hour. Thank you so much. Thank you so much to my lovely friends, Justin, Erket, Stewart, Bill Kay and A.L. Perry. Thank you for all your wisdom, and thank you to my audience for asking really great questions and really good comments. And don't forget to sign up to our investing newsletter. Thank you so much for coming along. It's been lovely to have you.